Alberta and Ottawa are reigniting discussions about a potential new pipeline to Canada's west coast.
Federal government and Alberta signed an agreement aimed at paving the way for a new pipeline that will help move oil from Alberta through British Columbia to Canada's west coast.
Canada's energy minister will brief BC Liberal MPs today on Ottawa's expected energy deal with Alberta. The Prime Minister has said any deal on a pipeline to the west coast.
Canada didn't whisper it. Alberta announced it with the force of a geopolitical earthquake. A massive block of Western Canadian Select crude, one of the largest shipments in 7 years, is now heading to China, not the United States. For decades, Washington believed one thing was certain. When America needed oil, Canada would deliver. But this week, that assumption shattered. Multiple U.S. energy officials privately confirmed that they reached out to Ottawa and Edmonton, urging Canada to prioritize continental security after refinery shutdowns tightened supply across the Midwest and Gulf Coast. But the answer they received wasn't what they expected. "We've already committed the volumes. The ships are booked," Alberta officials said. In less than a single quarter, the North American energy balance flipped upside down, and the United States, once the unchallenged buyer, found itself in the unfamiliar position of asking, what triggered this sudden reversal? Why did Canada turn away from its largest customer? And how did China manage to secure a long-term supply deal before the United States even realized it was happening? Tonight, we break down the numbers, the timeline, and the geopolitical shockwave now spreading from Alberta to Washington. Because this isn't just a trade shift, it's a revenge moment, decades in the making. To understand why Alberta pivoted, you have to understand the imbalance that existed for years. Around 61% of Alberta's oil exports normally flow to the United States, a dependency that left Canada with little leverage when U.S. refineries lowered demand or pressured for discounts. According to Reuters, May 22, 2025, this shift isn't speculation, it's backed by hard data. In its analysis, Canada's crude oil shift to China schools Trump in unintended consequences. Reuters confirms that for the first time, Canada exported more seaborne crude to China than to the United States. The report notes that China's demand surged as U.S. refineries cut purchases, creating an opening Beijing moved quickly to fill. And in late 2025, the squeeze tightened. Several major American refineries entered extended maintenance cycles, reducing their intake by hundreds of thousands of barrels per day. Prices dropped sharply for Western Canadian Select, hitting levels Alberta considered unsustainable. For months, U.S. buyers assumed Canada would simply accept the cuts. After all, where else could the oil realistically go? Keystone XL had been canceled, pipeline capacity was constrained, and Asian markets were assumed to be too distant, too complex, too expensive. According to S&P Global, September 12, 2025, the expanded Tan Mountain Pipeline, TMX, has completely reshaped the game. In its analysis, Chinese refiners embrace Canadian heavy crude via TMX. S&P confirms that Chinese refiners are sharply increasing imports of Canadian heavy crude thanks to TMX, a West Coast outlet many U.S. experts once dismissed as unrealistic. With TMX now operational, Asia is no longer a distant option, but a rapidly growing, fully accessible market for Canadian oil. But the U.S. miscalculated. China stepped forward quietly, offering higher premiums, lower discounts, and guaranteed multi-month contracts, a package Alberta hadn't seen in years. Negotiations began privately. The U.S. never noticed. By the time Washington realized what was happening, Alberta had already signed a memorandum of understanding with Asian buyers, finalizing terms for a large winter shipment. The United States thought Alberta didn't have options. Alberta proved it did. And that first quiet deal, signed 1 month ago, became the spark for a dramatic realignment. The question now wasn't whether Alberta could pivot, The question was how big the pivot would become. The answer arrived this week, and it stunned analysts on both sides of the border. China's initial contract secures an estimated 260,000 to 300,000 barrels per day of Western Canadian Select for the next several months, an export volume large enough to shift regional pricing models and disrupt U.S. refinery planning. For China, the calculus is simple. WCS is cheaper than Brent, more stable than Middle Eastern supply during winter volatility, and available at scale. For Alberta, the benefit is equally clear. Asia is paying more, sometimes much more, than U.S. buyers offered throughout 2025. But the consequence for the United States is immediate. Losing even 12 to 15% of expected Canadian inflow during winter creates a vulnerability Washington hasn't faced in years. Midwest inventories tighten. Gulf Coast refineries scramble. Analysts warn that gasoline prices could rise another 20 to 40 cents per gallon. And while U.S. officials insisted that Canada remain committed to North American energy security, the reality is impossible to ignore. Some of the tankers have already departed from Canada's west coast, headed straight for Qingdao. No warnings, no delays, no chance for the U.S. to intercept with better offers. This wasn't an accidental shift. It was a calculated redirection of supply, one that signaled a new era where Alberta is no longer anchored to a single customer, and Washington is only now realizing the cost of assuming Canada would never look east. By the time the tankers were halfway across the Pacific, Washington finally realized the scale of the problem. Internal memos obtained by multiple outlets confirmed that U.S. energy officials urgently contacted Ottawa, urging Canada to stabilize continental supply as refinery shortages deepened across the Midwest. Some calls were described as tense, others as borderline desperate. But Canada's response was blunt. Alberta had already committed the volumes, and the agreements were legally binding. There was nothing left to redirect to the United States, not at the price Washington wanted. For American decision-makers, it was a stunning reversal. For decades, U.S. policymakers treated Canadian oil as an extension of domestic supply, always available, always discountable, always secondary to American interests. Not anymore.
When the U.S. pushed for last-minute deliveries, Alberta clarified that it would fulfill future orders only at competitive pricing, and only when capacity allowed. The old assumptions were gone. Meanwhile, consequences hit fast. Winter refinery output dropped. Regional gasoline prices spiked. Some analysts projected that the U.S. could face a 200,000 barrel per day shortfall through late winter, a gap not easily filled by Middle Eastern imports. One line in the leaked memo captured the frustration in Washington. Canada is prioritizing Asia. We misjudged their timeline. But it wasn't a misjudgment. It was the U.S. waking up to the fact that the world's fourth largest oil producer had finally decided to stop playing by America's rules. If anyone doubted who benefited from Alberta's pivot, the numbers speak for themselves. By shifting even part of its export stream to Asia, Canada stands to earn an estimated $1.2 to $1.5 billion more annually through higher premiums and reduced discounting. For a province like Alberta, where resource revenues shape budgets, this windfall strengthens everything from public services to long-term investment planning. And it's not just about revenue. The move gives Alberta something it hasn't had in decades: leverage. When the U.S. can no longer assume priority access, Canada gains negotiating power over pricing, policy alignment, and infrastructure decisions. Meanwhile, U.S. refiners feel the immediate hit. Those on the Gulf Coast are now competing with Asian buyers for heavy crude, a product not easily replaced. Many will be forced to import heavier grades from the Middle East at higher transport and insurance costs. The knock-on effects are significant. Shipping costs rise 14 to 18%. Refining margins shrink. Gasoline and diesel prices edge higher. winter energy policy becomes more fragile. This isn't simply an economic inconvenience for the US, it is a strategic setback. Washington spent years assuming it held the dominant position in continental energy. Alberta just reminded them that market dynamics, not political pressure, determine who holds power. Canada didn't set out to punish the United States, but the outcome looks a lot like payback. The most important part of this story isn't the shipment already heading to China. It's what Canada is planning next. Alberta's decision was not a one-off response to temporary U.S. weakness. It was the first step in a larger strategy to diversify away from reliance on a single market. Infrastructure expansions on Canada's west coast, including upgrades in Prince Rupert and Kitimat, are designed to accommodate a surge in tanker traffic by late 2026. If timelines hold, Canada could redirect up to 35% of its export capacity toward Asian markets within the next 2 years.
Behind closed doors, Japan and South Korea have already initiated early-stage talks for similar long-term purchase agreements. These nations want stable, ethically sourced energy. Alberta wants buyers willing to pay for reliability. Both sides see opportunity. This shift also means something deeper. Canada is positioning itself as a Pacific energy power, not just a North American supplier. The U.S. once believed it controlled the flow of Canadian crude. Now it risks becoming only one customer among many. In Washington, analysts are beginning to say the quiet part out loud. North America's energy balance will change permanently if Canada keeps moving east. And Alberta shows no sign of stopping. The contracts, the infrastructure, the diplomacy, it's all pointing in one direction. A future where Canada decides who gets its oil, not the other way around. What's unfolding isn't just an economic pivot, it's a geopolitical repositioning. By redirecting oil toward Asia, Canada is gaining something the United States never expected: strategic influence in the Indo-Pacific. Asian governments have long sought energy suppliers that are stable, transparent, and insulated from the political volatility of the Middle East. Alberta's heavy crude, paired with Canada's regulatory reputation, offers exactly that. As a result, energy analysts across Tokyo, Seoul, and Singapore are now placing Canada on the short list of reliable long-term partners. With every new shipment east, Canada strengthens its relevance in trade negotiations, defense dialogue, and regional supply chain planning. In contrast, the United States finds itself losing a lever it once used freely: control over continental energy flows. This shift doesn't mean Canada is abandoning its allies. It means Canada is no longer defined by a single relationship. In the Pacific century, that independence carries real geopolitical weight. When Alberta's first tankers sailed toward Qingdao, the message was unmistakable. Canada will no longer let the United States dictate the terms of energy trade. Washington asked for supply, but Canada had already turned the page. This wasn't retaliation in the traditional sense. Canada didn't issue threats, warnings, or ultimatums. It simply followed the numbers, and in doing so, rewrote the balance of power. Alberta proved that leverage belongs to the seller, not the buyer. And if Canada continues expanding toward Asia, North America's energy hierarchy may never return to what it once was. The U.S. is now facing a reality it never prepared for. The world's most reliable supplier has options, better ones, and Canada is using them. The revenge wasn't loud, it wasn't dramatic, it was contractual, and it was final.